Every single day, $7.5 trillion changes hands in the foreign exchange market. That immense volume makes it the largest decentralized financial arena on Earth. Unlike a traditional stock exchange that rings a closing bell, this market flows continuously from east to west. It operates 24 hours a day, 5 days a week, following the sun across global time zones. To access this market, everyday people trade currencies in pairs, like the euro and the US dollar, seen here. When entering a position, you are simultaneously buying the base currency while selling the quote currency. This sequence shows an exchange rate moving from 1.0850 to 1.0851. That tiny shift in the fourth decimal place is called a pip. It is the primary unit of measurement traders use to track micro-movements in price. This massive, fast-paced liquidity offers a unique opportunity, provided you look past the headlines and into the mechanics of how these trades actually function. Those mechanics start with margin and leverage. These tools allow a retail trader to put up a tiny deposit and control a massive position in the market. Look at this balancing scale. With a leverage ratio of 100 to 1, a small margin block of $1,000 effectively matches the weight of a $100,000 standard lot. The math can work incredibly well in your favor. If you hold that position and the market moves exactly 1% in your intended direction, you generate $1,000 in profit. You double your actual deposit. But watch the exact same scale in reverse. A single 1% move against your position instantly wipes out your entire margin. This mechanism is the primary reason beginners blow up their accounts. Leverage gives you the buying power to enter the arena, but it will bankrupt you unless you deploy a strict mechanical shield to protect your capital. To avoid gambling with that leverage, you have to form a hypothesis based on hard data. Traders build these strategies using two primary schools of analysis. The first is fundamental analysis. This focuses on why markets move. Traders monitor the institutional engines housed in places like the Federal Reserve, tracking interest rate decisions, gross domestic product releases, and shifting geopolitics. The second is technical analysis. This tells you when markets might move. You look at historical chart patterns and mathematical indicators, like the relative strength index, to map out human psychology and find precise entry points. Modern, risk-conscious traders synthesize these frameworks, meshing the economic calendar with candlestick charts to identify high-probability setups. A data-driven hypothesis gives you a logical battle plan, but if you try to execute that plan without proper mechanics, your capital is completely exposed to sudden volatility. You cannot jump into a live market blindly. You have to control exactly where your money enters and exits the trade. You might use a market order to buy in immediately at the current available price. Or if you want a specific, highly calculated entry level, you set a limit order and wait for the market to come to you. But getting into the trade is the easy part. The single most critical tool you will ever use is the stop-loss order. Watch this descending trend line. Real capital preservation requires strict behavioral rules, starting with position sizing and the 1 to 2% rule. The rule is absolute. You must never risk more than 1 to 2% of your total account capital on any single setup. If your stop-loss triggers, that small percentage is the maximum you lose. You combine that maximum risk with your target take profit to calculate your risk-reward ratio. This configures the exact geometry of your trade. This bar shows a 1 to 2 ratio. You risk $1 on the red side to capture $2 on the green side. With this math, you only need a 34% win rate to break even. True longevity in Forex relies on organizing your structural math so that wins naturally outpace losses, regardless of the individual trade outcome. If you ignore that math, you invite the chaotic, emotional pitfalls that destroy basic discipline. Traders routinely over-leverage out of simple greed, or dive back in for revenge after taking a loss. The only way to bypass these psychological traps is to follow a pre-written, inflexible trading plan that dictates your exact strategy and maximum daily risk. And before you ever test that plan with real capital, you have to practice executing those strict protocols in a live, simulated environment. Opening a free FXNX demo account gives you the space to master platform mechanics and test your risk ratios. You get to interact with live market conditions using virtual funds until your execution becomes automatic. Forex trading is a marathon of risk management. By combining strict mathematics with the institutional tools at FXNX, you build the foundation to protect your capital, execute your plan, and thrive from day one.